Well, what could happen in the quarter coming ahead for Axis Bank? Difficult to say, but it did post a significant uptick after the second quarter earnings. The GDR already jumped 7% after the private lender posted 82% growth in profit numbers. Darshan Mehta is standing by with the fine print of the numbers, not just the headline, and what brokerages are making of these numbers as well. Morning, Darshan. Happy Dhanteras.
Happy Dhanteras, Niraj. Yeah, numbers were good. 7% growth on the 7% rise in the GDR indicates that probably we will also have a similar rise, probably even more, because we are much more liquid than what the GDR is. Basically, profit 82% was expected, but slightly better than what came out. Even the NII growth was decent. It came in at almost 15%, 5,230 crores versus our estimate of 5,150 crores. The other part was that the asset quality improved significantly. Now, GNPA fell to 5.96 from 6.52, and then net NPA fell into almost 2.54 versus 3.09. So there is a positive trend that is there. Some of the factors that we need to watch out for: first of all, the core PPOP growth of 15% was driven by a beat on the NII. Lower slippages this time around and significant improvement in the NPA will certainly definitely benefit Axis Bank this time. Almost 1100 crores of the 28 crores was corporate slippages, and the management has indicated that the downgrade cycle is nearing an end. So that is something that should be taken out on the positive side. BB and below book has reduced significantly, indicating that the asset quality has improved significantly. And exposure to IL&FS, they said that was 830 crores, out of which 240 crores is fund based. So not that much concern that someone would have with an IndusInd Bank, which the exposure was over 3,000 crores. A lot of brokerages came out with notes. Most of them are positive. Some of them have raised the target price, but a consensus target price is coming in close to 750 because Nomura has raised the target price to 750. They're saying that the PPOP improvement and credit cost that will normalize is positive, and that will lead to an ROE expansion. CLSA has revised the target price to 750 from 690, and they're saying that the key positive was the moderation of slippages. They are positive on it. Credit cost to fall sharply from FY20 is what they are anticipating. Antique is saying that the last two quarter performance instills confidence in the corporate recovery cycle, and Deutsche Bank is maintaining a buy with a target price of 750, and credit costs they believe should fall materially from the third quarter onwards. So overall, on all fronts, I think it's a positive view from the brokerage side, from their numbers versus the estimate, from how the GDR reacted. So I think it's a given that Axis Bank will have a strong opening today.
Well, Darshan, thanks for putting that into perspective. That's our head of research, Darshan Mehta, talking about Axis Bank and what the stock could do in the session today. Well, difficult to... All we can say is the stock will likely start positive, and the GDR gave the impact thereof. When our guests come in, we'll talk to them about what's the extent of gains that we could see in Axis Bank in the session today. Could well turn out to be the stock of the day. Well, the other one that is an intriguing stock in the session today is SAIL. It's returned to profits in the September quarter. But let me just try and take a moment to explain why SAIL becomes very important as a stock in the session today. I'll just go across to the wall to try and tell you why this becomes a very important stock to monitor in the session today. Firstly, the numbers, and the numbers will come up on your screen in just moments from now. Just the reported numbers. I'm not giving them versus estimates, just the reported numbers, and then of course we'll get in all the finer points for SAIL in the session today as well. These are reported numbers. Revenues up about 22%. Bottom line, well, from a loss into the profit of 554 crores. So exceptional quarter on a reported basis for SAIL. It's a good quarter is all I'm trying to say, even though it's below estimates. EBITDA, well, up about 158% at 2365 crores, and margins at 14.1% versus 6.7%. Remember, in the previous quarter as well, SAIL had positive margins, or rather double-digit margins, about 15.5 or 16 odd percent. So the first half of this current fiscal, SAIL has posted some very good numbers. Now, what are the factors that you need to monitor when it comes to SAIL? Firstly, capacities have been upped over the last few years from 14 million tons to circa 21 million tons. So they have the capacity in place to produce more, and a better product mix and cost control will only aid margins. We are probably seeing the first signs of that in the half year gone thus far, and maybe that will only improve going ahead. Now, this is the note, that is the chart that I've borrowed from company data as well as Haitong Securities note, and they are talking about two charts. One is how the coke rate coming off will help SAIL in improving their margins. And then, of course, the better product mix and lower employee costs will help SAIL in a meaningful way in trying to improve their margins. I think those numbers will come up on your screen and you will see what I'm talking about. This is the employee cost as a percentage of sales. And look at what used to happen in the past. So FY13 employee cost as a percentage of sales, 19%, went up to 20.5%, 21.3%, 25%. Then FY17 about 20.6%. FY18 that came down meaningfully. And the first two quarters, Q1 FY19 and Q2 FY19, something that I've calculated, 12.92%. So as you can see, there is a definitive downtrend in employee costs as a percentage of sales for SAIL. And when I spoke to experts, all of them said that the biggest bugbear for SAIL used to be employee costs, which used to be very high. If they're able to bring these down, then it's a big positive for SAIL. The other point is the room to bring down the employee cost. Now, per ton, SAIL continues to pay substantially higher employee cost per ton compared to JSW Steel, which is fairly integrated as a player, converter of sorts, and Tata Steel as well. So all I'm trying to say is that it's not that SAIL will bring it down to these levels, but that even though they've done quite a bit of work, there's still room to improve their employee costs per ton of production, whether production goes up or whether the number of employees come off, or there are stricter cost controls as well. Other fact is better cash flows will help deleveraging. Now, there are no new capex plans for the next 3 years. And look at these charts, the interest coverage ratio. These are all estimates from brokerages, again from Haitong Securities. So the net debt numbers are expected to come down FY19, FY20, FY21. The net debt to equity will also taper off a little bit. And the interest coverage ratio, which was woefully low in the year of FY16, since then has moved up and is expected to reach even higher levels in the next 2 or 3 years. So the ground is set for SAIL to be able to do well. The problem is the analyst community split right down the middle. Now, if you look at the ANR, the number of buys versus the sells, 42% have buy ratings, 33% have sell ratings. And while the return potential is still about 20%, the only difference in why these brokerages have a difference in opinion is one, the EBITDA estimates, and two, the multiple that you assign to the EBITDA estimates. So, anywhere between 5 times to 6 times FY20 EV EBITDA multiples is what brokerages have assigned. And depending on the EBITDA estimates that you have, then the target prices differ from being as low as 70 rupees to as high as 120 rupees in certain cases as well. So brokerages split right down the middle. The question mark only is whether it can do well. However, just one point of caution. Remember, the numbers have been good but below estimates, and brokerages have posted certain points that you should monitor, the key risks, if you will. The concerns remain. One, the ramp-up delays, if they come about this. I've borrowed from the Bank of America Merrill Lynch note that Nikki sent to me. The rise in employee costs, even though they're trying to control, those costs remain at elevated levels, as I showed in the previous chart, compared to JSW Steel and Tata Steel. And a product mix deterioration. If indeed the product mix deteriorates as opposed to improve, because a key factor for SAIL is that the product mix improves. And if that doesn't happen, that's a problem. And regulated relays for new iron ore mines, this would be a key concern as well. So you got to keep in mind that all is not hunky-dory. They're trying to improve meaningfully. Hopefully they can do that. Today's day, the numbers very good, but below estimates. Difficult to quite predict how well the stock could react. Keep in mind, it's already gained about 9 or 10% ahead of the numbers. So that's the other thing that you got to monitor in the session today.